It is being reported today that Washington, D.C. is in crisis as home prices have plunged about $140,000 since the start of this year. Unemployment rates are skyrocketing, and Google Trends searches in the District of Columbia for criminal defense attorneys are skyrocketing to levels you really have to question. But all of that aside, could this be something the Fed looks at and kind of changes the economy or the dynamic of Fed policy? Here in this video, we will discuss just that, why Doge and government will actually force the Fed to be a lot more accommodative than you would think. And what could be the Fed that cuts rates multiple times this year? I want to acknowledge it is a slippery slope between the economy weakening too much, where it's a problem, and the economy weakening just enough to spur, well, more easy Fed policy and higher highs for stocks. First and foremost, quote unquote, government recession begins. DC active home listings soar, jobless claims spike as Doge drains the swamp. It is being reported that since Doge has began discussing mass layoffs, the median home price in Washington, D.C. has fallen by $139,000 in just 30 days. 4,000 homes have been listed for sale in and around Washington, D.C. Unemployment insurance claims have, skyrocketed to about 2,000 per week, which is about 4 times the average you had in 2024. The percent of balances 90 days or more delinquent by loan type is also skyrocketing. Credit cards are at the highest level you've seen since 2012, which is about 12% or so delinquent. Auto loans still below the 2020 high, but starting to break out to levels you really haven't seen since the global financial crisis, whereas student loans, mortgages, and revolving lines of credit are still well below any cause for concern. So I would argue here that there is more weakness that perhaps is not being shown in the economic data, but not necessarily something that should cause you to sell all the stocks that you own per se. Seth Golden reports on X that timeframes matter. While recent sentiment has fallen significantly, 2024's average bull-bear spread was the 3rd highest in history. Forward 12-month SPX returns from bull-bear spread years have been terribly muted on average. So you can see that in 2024, you had a bull-bear spread of 38.2%. Average return the next year is only positive 0.4%, with a lot of years the next year having a really bad year. But what's also interesting is years of depressed sentiment and subsequent market action. As we have today, investors are very bearish. You can see in the next year, you tend to have very outsized positive returns with an average return of 18.9%. So technically, this data is saying this year may be a little on the slow side, maybe not the best return, but next year could be really good. As I have reported here on this channel many of times now, the bearish sentiment is at multi-year highs. It's actually insane. We've seen Nvidia fall almost 20% in a single day. Yen carry trades blow up. You've seen bank runs and disasters, right, in the banking system, regional banks. And you are now more bearish today than you have been versus any of those other events. 47.3% of investors are bearish, 24.3% are neutral, and 28.4% are bullish. That means roughly only 0.25% of investors expect the stock market to be up 6 months from now. 24.3% expect it to really do nothing, and almost half of investors expect the stock market to fall. Usually when you're this bearish, it's typically a good time to actually go out and buy. Percent of stocks trading above their 50-day moving average at 51.4%. Again, about half of markets are not even above their 50-day moving average. So yeah, that's also, a pretty contrarian bullish indicator. And the CNN Fear and Greed Index is at 44, which is in fear territory. Market momentum is neutral. Stock price strength is fear. Stock price breadth is fear. Put and call options greed. Market volatility is neutral. Safe haven demand in fear. And junk bond demand in greed. Also in the news today, Trump's administration has identified 15,000 IRS employees to potentially fire starting next week. And it is already reported that you've had about 250,000 government layoffs since Doge's creation. And Doge has already paid saved US taxpayers $102 billion. And you're likely to see the cost-cutting efforts really ramp up here over the next coming weeks and months. And for this economy, which government jobs have been a main contributor over the past couple of years, to see a reduction in government jobs, while also to see a slowdown in immigration, leads to one thing. Well, two things technically. It leads to disinflation, and it leads to a weakening economy, which is going to force the Fed into acting and cutting rates. Now, here's the situation, though. Disinflation, a more fiscally responsible government, is going to bring down 10-year Treasury yields. As Scott Bessent, a guy that is now the Treasury that worked on Wall Street his entire career, has told and advised Trump, you don't need to bully Powell. And that's why Trump has really not said anything to Powell or about Powell. Bullying Powell into cutting short-term rates is not going to do anything for mortgage affordability or for, other lines of credit to become cheaper via interest rates. You really need to focus on the 10-year Treasury. And that is what Scott Bessent has informed Trump of. And this is why you are seeing Doge going so aggressive and cutting cost to rid this economy of inflation and to lower 10-year Treasury yields. Scott Bessent has a 3-3-3 initiative. 3 million barrels of additional oil per day, 3% debt or deficit to GDP, and 3% GDP, which on, paper, in theory, that sounds absolutely phenomenal. Stocks would love that. The bull market would just go on and on. That is a goal that this government has by 2028. And yeah, unfortunately, there's going to be some hard times during some of that, at least initially. And I think that's what we could be heading into coming in April or May or so, as some of these cost-cutting efforts eat into economic activity. After all, we did see retail sales, which were forecasted to come in at about 0% in January, actually came in at negative 0.9% for a month-over-month reading, which if you look at the last 12 months, this is by far the worst retail sales that we have seen. Now, this did cause 10-year Treasury yields to fall on Friday. They fell about 5 basis points, but I believe 10-year Treasury yields are going to fall a whole hell of a lot more in the next coming months. And this could be very positive for stocks as long as earnings continue to hold up, as long as we don't see downward revisions to earnings estimates, and as long as there is really no serious concerns about a recession. This could be a very positive environment for stocks. And if you are a viewer of this channel, in the short term, well, you're actually in a new technical breakout for the S&P. You've broken above your downtrending line of resistance. Last time this happened from the break, you had a rise of about 2.5%. If that happens exactly the same again, you're going to see the SPY at about 621 to 623 or so, which would be about 2.5% upside from here, but send us to, obviously a new all-time high, but what could be a new trading range. And I expect we will get some consolidation between now and then, and that's something to also consider. Seth Golden writes on X, the final 2 weeks of February have proven the absolute worst for SPX returns since 1928 and the third worst since 1950. Now, if we all expect it to be bad, a lot of the time it's not bad. It can actually be really good. So the second half of February, really bad, almost a 1% negative return during this period. First half of February tends to be pretty good, in which we've kind of seen that. Now, the first half of March is also a pretty good time for markets. You could see that here with an average return of about 1%. The second half of March, you don't tend to do much at all. You tend to be about flat. The first half of April, though, tends to be the third best 2-week portion of the year. So really, when you get through the second half of February, things should start seasonally getting better. JP Morgan also says if you're trying to time the AI top for the NASDAQ, if you're 1 month early, that could mean a 13% opportunity cost, 3 months early, a 31% opportunity cost, and 6 months early, a 94% opportunity cost. They say either this is not a bubble or you will be early. Speculation is the enemy of a savvy investor. Basically saying you have to have almost perfect timing to make it make sense to short the markets right now. And I will just say, I don't think AI is a bubble. I don't think anyone really thinks AI is a bubble. But for the headline S&P, there could be some issues. Hyperscalers, right? They're already multi-trillion-dollar companies. NVIDIA has already seen a lot of demand from, AI and semiconductors. And this is one reason why I'm not that bullish on the SPY itself, is because you could see those big tech stocks really take a back burner over the next couple of years, but AI software, AI appliers, robotics companies really take the lead with AI. You could see value stocks start to come back and dividend payers come back as 10-year treasury yields fall. As 10-year treasury yields fall from 4.5% down to, let's say, 3%, that 6% yielding dividend stock looks a lot more attractive than it, otherwise did when the 10-year treasury was 4.5%. So I think you're just going to see a different areas of the markets actually participate. A more broad participation where Mag 7 may not participate. And in that scenario, you would rather be a stock picker than an indexer. And for a lot of people that are passively indexing into this market, that could be a little problematic from a, missing opportunity kind of standpoint. But again, back to the main topic of this video, Doge, government spending reductions, and ultimately government layoffs are going to eat into economic activity, and the retail sales numbers could just be a start. We're probably going to continue to see some weakening in the economy, which for the Fed that's really sat on their hands for the last month or so, really not trying to get involved with politics at all, this could feed into the Fed's narrative and force the Fed to begin cutting rates. Now, this time around with government spending cuts and what appears to be a more fiscally responsible path ahead, that could actually drive down 10-year treasury yields when the Fed cuts rates again, which is, much different than we've seen the last 4 rate cuts where the Fed cut rates 1%, 10-year treasury yields went up 1%. 314's Warren Pye says he expects to see a growth scare in late Q1. He actually said this almost 3 months ago, and he is sticking with this with a new call on Friday. I actually shared this clip on the channel with you guys once before, so if you've seen it already, feel free to skip ahead. But it's so out of consensus that you got to respect it at the bare minimum, but you should always seek out different opinions, right? If you're super bullish, on the economy or whatever it is, you want to seek out a bearish opinion. You want to challenge your own views, not confirm and conform to your own views. And I think this is so, again, out of consensus that it provides a lot of value. So take a listen.
Bigger breakout could be in the cards, but I see here that you took your weighting to stocks down a bit. Am I reading that right?
You are, yeah. So we were running an excess long position, and we just neutralized that last week. And so I think the bottom line is it's too early to outright worry, but you need to start looking ahead to some potential risks in this market. And like you said, the market's been in a really tight range. It's 6% plus or minus for the last 3 months. Really, if you go back historically since 1950, this tight of a range only occurs about 13% of the time. And you really need to be patient and watch where the market breaks. And our view is we're going to break out to the upside in the very near term, which is positive. But when we get out to spring, I think you need to start taking some precautions when we get out to spring.
Why are you overweight bonds?
I just don't see. Number one, I think disinflation is going to bite pretty hard this year, and I think that the gist of our concerns out in April are growth concerns, and so I think for the first time in a while, bonds are providing a really nice diversification benefit for your portfolio. I see the consensus that it comes on TV and just out in the financial news in general, and they're saying no cuts this year. The Fed's going to be on hold all year. I don't think the economy can handle that. I think that the housing market at 7+% mortgage rates doesn't really work, and we're going to see that. Really, it's going to be about April, May when I think those cards are kind of flipped over, and we can see that clearly.
What role are tariffs going to play in all that?
I don't think so. Our view is not that tariffs themselves are a major problem for the economy or the market or for inflation even. But what I see the major impact that tariffs are going to have is on the Fed. So, if we look at last year and this year, we just had this hot inflation report. I think if you dig through it, it's not that bad. We had a very similar residual seasonality last year, the first 3 months of the year, hot inflation. The Fed was very quick to calm everybody down and say, we want to look through this. It was an election year. The Fed was much more prone to cutting last year. I think that the role tariffs plays is it gives the Fed a potential excuse or at least a reason to be less reactive to inflation. So when we go out into April, May, say, why are you so concerned April, May? We have that March Fed meeting. I think that tariffs and the threat of tariffs at that point in time are really going to cause the Fed to continue on this hawkish pattern. And they're going to be doing that at a time where the economy is slowing. Tax receipts are coming in strong. Whenever you have a strong bull market year in the preceding calendar year and you go forward in it's time to pay the tax man, that's usually a weak period for the stock market. So I think all of those things come together around April, right after that Fed meeting. So tariffs, I don't see them as a threat in and of themselves. I see them causing the Fed to be more hawkish, though.
More hawkish. But eventually, though, it sounds like you think they're going to have to act. I mean, if the economy is going to slow more dramatically than maybe some people think, and I mean, you're thinking about Doge also, right? If you're going to cut spending that dramatically, you're thinking about growth taking a hit as a result. So a more hawkish Fed turns into a more cutting Fed, though.
Yeah, I mean, like right now, I'd say if you look at the futures market, there's like one cut priced in Fed SEP is like 2 cuts priced in for the year. I think we're going to take the over on that. So I think we're going to have 3 or 4 cuts still this year. And it's really just a matter of how painful it's going to be to get there. If the Fed wants to stay really what we're calling a recalcitrant Fed, if the Fed wants to stay combative or recalcitrant, then I think it's going to be a tough time for the markets. But ultimately, one way or another, I do think we're going to get cuts. They might not come till the back half of the year, but I'm taking the over. That's part of why we want to be overweight bonds here. I think the Fed cuts 3 times, if not 4, this year.
You want to be overweight or market weight on tech? I mean, there's a pretty good debate, I think, to that question being asked right now.
I want to be overweight personally. I look at this, the growth scary. And so part of deciding what to be overweight is looking out and not making mistakes. And so I want to have interest rate sensitivity in my portfolio. So maybe utilities, interest rate sensitive stocks like that. And I think large cap tech, they've trailed the market here. We've had a broadening out, but ultimately if the market's going to break out and really you want to be bullish, then I think those are going to have to be the leaders still. And I think I have a hard time. You look at where earnings are supposed to come from. You see the big role that semis play, NVIDIA plays. Those have to be the leaders. If we're going to have double-digit earnings, which I think we will, it's going to have to come from the tech sector still. And so to me, yeah, I want to be overweight tech. It has some defensive characteristics given the growth concerns. I want to be underweight resource stocks in this environment. So I want to be underweight energy. I want to be underweight miners and things like that outside of gold, and stay sort of defensive in my weightings within the market.
To next week, we don't have much for economic data at all. We do have the Fed's FOMC, so that's kind of like a transcript of the last Fed meeting to a certain extent. They kind of give you the details they want you to know. They leave out a lot. So it doesn't usually move the markets all too much, but kind of reinforces what the Fed said at the last meeting. So it can move markets, doesn't necessarily have to. On Monday, you just have a couple Fed speakers, Fed Harker, Fed Bowman, Fed Waller. Are they bullish? Are they bearish, dovish, hawkish? We want to know all of that. But, single opinions really not going to move the needle too much. On Tuesday, New York Empire State Manufacturing Index, Fed Bar that speaks, that he never moves the markets. He's the top guy for like banking regulation. He never moves the markets, actually. Wednesday, you have building permits and housing starts that will be coming out. And then here are the FOMC minutes. Fed Jefferson speaks at 5 p.m. On Thursday, Philly Fed data, initial jobless claims. I think initial jobless claims will actually be very interesting to watch, given what's happening in D.C. and what's being reported over this weekend. Do we start to see a material rise in initial jobless claims? If we do, then that's something the Fed could start to pay more attention to, because, again, the last thing the Fed wants is to be wrong twice. Okay, they were already wrong once, too late to start raising rates in 2021 and 2022. Okay, they didn't act fast enough. The last thing they want is to not act fast enough to curve a downtrend in the economy, especially when there's, I would say, like record amounts of people calling for the Federal Reserve to not be independent anymore. There's a lot of questions around that after the Fed got it wrong the first time. So absolutely, the Fed does not want to get it wrong again on the downside. And that's why they're being so careful right now not to make a mistake. But on Friday, we will get S&P Global Composite PMIs, manufacturing PMIs, and services PMIs. You're actually expecting services to get a little bit better, manufacturing to get a little bit better, and the S&P Global Composite PMIs, this is for the United States, to roughly stay the same as last month. And services last month actually came down quite a bit. I think there's a risk of that for the economic data just to come in on the low side here over really the next couple of months. And that's where you're going to get the Fed that takes notice and starts to flip-flop. You also get Michigan consumer sentiment. Final numbers here. The big thing you want to watch is inflation expectations. This survey is very politicized, but the one-year inflation expectations actually skyrocketed last month from 3.3% to 4.3%, skewed by Democrats expecting hyperinflation, independents expecting 3.2% inflation, and Republicans expecting no inflation. Those Democratic respondents really skewed the expectations here. So we'll see if anything changes there. But that is pretty much it. We will go over next week a little bit more in depth in the next video coming tomorrow, because markets are closed tomorrow for President's Day. So keep that in mind. There's no trading on Monday, but it does say you do still have some earnings here, so we will see. We do have Baidu Tuesday, Arista, Oxy, Devon, Toll Brothers. We have Etsy this week, Solar Edge, Analog Devices, Fiverr, Carvana, Toast, Cheesecake Factory, Exact Science, Alibaba, Walmart, Unity, Wayfair, Mercado Libre, Rivian, Block, Newmont, Bookings, Texas Instruments, Five9, Dropbox. Couple names Friday. The big dog this week is really Walmart. Walmart is kind of that bellwether of the economy. If Walmart is starting to see some weakness, that's what Wall Street's really going to pay most attention to in this upcoming week. And really, it's all about Walmart's guidance for 2025. So, and I even think Walmart, what they say is going to be really important for the Fed. Give them another piece of information to go off of, because Walmart literally has a grip on every consumer demographic in the U.S. And, Walmart's the biggest employer of people in the U.S. as well. So that's definitely something to consider also. Ladies and gentlemen, that is going to do it for this video. Hit the like button and subscribe to this channel if you have not done so already. Have a great rest of your day, and I will see you in the next one.